It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome to the Jill on Money show. It is December. Aren't you excited? This is a program that takes the mystery out of your financial life. And yep, it is getting down to it. I cannot believe we're saying it, but we are. And we should, and we will continue to do so, at least for another few weeks. We are going to talk about some year-end planning in this episode. We're going to do that in the second hour with our favorite recidivist guest, Brent Weiss from Facet Wealth. As many of you know, Facet Wealth is the sponsor of this program, but Brent used to come on the show before they were our sponsor, so I should point that out. And I should also make sure that we do our proper Facet Wealth introduction, which is we like them because they do a lot of financial planning for people like you, perhaps. And the part of their planning process that I love is they have no wealth or account minimums. Facet meets you where you are. They do goal-based financial planning. You get it from a dedicated advisor. So boom, just like that. See, Mark, I got this whole Facet stuff out of the way early on in the program. Is that better or worse? Sometimes I like getting it over with. You feel okay about that? Get it over with. That's right. We're getting it over with. Anyway, Brent's great. He'll be with us later in the program. Okay, so we are here to take the mystery out of your financial life. How do we do that? We answer your financial questions. And we do that by encouraging you to go to our website, which is a work in progress. According to Mark, I get a big reveal this week. Are you nervous for me? Do you think I'm going to have a good or a bad reaction? What's your worry here? All right. Mark says I'm going to like it. A brand new JillOnMoney.com website. Do you know what the most consistent aspect of the whole website is? That you will be able to click on the contact button pretty much from anywhere. That was the main thing that Mark and I wanted when we talked to our web designers. And by the way, the person doing our website, a listener. Isn't that cool? I love that. That is the best part of this community. So great. You guys take care of me and Mark, and we take care of you. So if you wouldn't mind, go onto the website. It's not new yet, okay? So don't worry. Bookmark it, because when we turn that stuff on, it's going to look great. And you can tell us what you think. And send us your questions. Again, just go to the website, JillOnMoney.com, click on the contact button. JillOnMoney.com, click on the contact button. Okay, let's answer a question, because we do have some emails, and, we want to make sure that we kind of answer those questions as well as get you on the air. So this is from Jeffrey, and the subject is new baby. I'm already interested. Going part-time. On track? Jill, I'm 39. My wife is 31. My wife and I just welcomed our second child, and she's going to take off 3 months. Then she's going to return to work at a reduced part-time wage, which would be a 24-hour week down from a 40-hour week. Okay, so he wants to know how they're currently doing for retirement. And he says, I had a late start to my career, and I'm 8 years older than my wife. So he says, I could be retiring earlier than her. Let's see if you can. Wants to know what to be adjusted, and wants to know whether to change funds. Okay, they have a $20,000 car loan at 3%. They have a $260,000 mortgage at 2.5%. They make $150,000 for him, and hers was $78,000. Oh, that's a nice income, huh? They delayed investing to pay off, oh my God, $260,000 in combined high-interest graduate school loans. How about that number, Mark? $260,000. For 401ks, he's got $400,000. She's got $40,000. He's got a $35,000 Roth. She's got $7,000 in her Roth. They've got $40,000 in a health savings account. I think this is a 529. This looks like a typo. $13,000. They're putting $200 a month in. Mutual fund, $20,000. Index retirement, they contribute $400 a month. Emergency fund is $35,000. Okay, so they're maxing his 401k. They get her 3% match by putting 6% into the 401k. Oh, but she loses that when she goes part-time. They max out their Roths and HSAs. Huh. Okay. So now where do we start? I mean, it seems fine. Your retirement trajectory looks fine to me. I mean, you're a little light. You're getting a late start. I don't know when you think you're going to retire, but probably not for a while. He's not asking whether she can go part-time. He's saying she is going part-time. So it's probably going to be, instead of 150 for him and 78 for her, it's probably going to be like 150 and maybe 50 for her. I think what I would probably do, I don't know if I'd put that. Why are you putting the money in the mutual fund right now? I'm trying to look at this. So they're putting 400 a month into the mutual fund outside of retirement. I guess because for her, she's going to lose her 401k anyway. So I'm not sure how much more they can do there. What do you think about the breakdown here in terms of what they're putting money? So he's maxing out his 401k. They're both maxing out their Roths. What do you think, Mark? Enough or not enough? Well, he didn't say what his cash flow was, but I'm figuring if they paid off $260,000 in grad school loans, they got good cash flow. Yeah, I think you need a little more of cash in your emergency fund, especially since she's going part time. I think that in general, I'm okay. So the money that you're putting into the 529 and the mutual fund account, that extra $600 a month, I just might redirect that so you have a little bit more money in your emergency reserve. And then, I'm probably not going to convince you to stop doing the 529, but I'd rather you just put your money in the mutual fund account. But the 529 is fine. You can keep doing it. Um, you know, there's not much more here to do in terms of, investments. I think that, she's got a target retirement index. It would be fine for me if you guys just had, an index fund of, 1, 2, 3, 4 index funds and call it a day, stock, bond, maybe a little commodity, maybe a little real estate, and be done. Um, Beyond that, I don't know. You're going to have to look at retirement calculators and see where you land. It probably looks okay. I don't think you're going to be retiring when you think you're going to be retiring. So when you say whether you're on track for retirement, it's predicated on when you think you will be actually able to retire. And that I can't tell you. I mean, I would run the number and look at 70 and see how it lands, maxing out, right? That's what I would do, and run the numbers. And there's not a ton more to do. I just want to make sure you guys have your estate planning, that you have enough enough life insurance. That would be really good to make sure you have. And if there's a more specific question after you run your numbers, let me know. But run that number and see what happens when you retire at 70. And also maybe consider that your wife would go back full time when the kids are in school, because I'd like that 401k, Mark. I sure would like that 401k back. That's just me. All right, you're listening to Jill on Money. If you have a financial question, just give us a holler. Again, it's jillonmoney.com. Click the contact button and we will get your note. Okay, we will be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and we are here trying to take the mystery out of your financial life. When you ask, we did a question. If you missed the first segment, we were asked a question of 30-somethings who were making some changes in their lives, and they wanted to know, are they on track? When you have those kinds of questions, the more detail, the better. Like, I'm planning to retire at this age. We have this much life insurance, and let us know if you have your wills done. Mark, maybe we should have like a little, remember the index card book? Maybe we'll just do like the the 3x5 card of Jill on Money questions that we always ask. And then we'll just put it up there and we'll say, okay, almost like you're completing an intake form, like you were going to the doctor, something like that. I don't know. Anyway, I'm thinking of a lot of things as we redesign our website. All right, we are going now to talk to Maureen in New York. She's already retired. Hello, Maureen. How can we help you out?
Okay, I have some questions about our traditional IRAs, which also encompass some 401ks and doing Roth conversions. We have about 2.6 million in all of our retirement funds, of which about 400 is Roth IRA. We've been retired for about 2 years. And so last year we started doing conversions to keep us up to the 22% tax bracket. And I'm wondering if there's just a rule of thumb of how much we should be looking to convert to Roth.
So tell me a little bit about yourselves. You've been retired for 2 years. There's a selves, so there's a plural. So you and a spouse, how old are you?
And we're both 67.
Okay. Are you collecting Social Security?
I am, and I collect about $2,000 a month. My husband is going to wait till he's 70, and he has a small pension that's about $2,000 a month.
And he's collecting that pension currently?
Oh, yeah. Okay. He's collecting that pension, yes.
Okay. How much money do you have that is in non-retirement assets? What are you paying the tax? How are you paying the tax that's due on the money you are converting?
We have about $350,000 in cash.
Okay. Is that it in terms of the cash?
Yes. Yeah, that's it.
The idea here is that we really need to make sure that many people who are in retirement, if you're listening, that you have liquidity. And what do we mean by that? I know that you want to convert as much as you can, but you're going to have a big tax bill as a result, right? In your look ahead, let's just talk about where you are right now, that you've got $4,000 a month coming in income, right? And so I'm wondering, how much do you need when it comes to retirement income? What's the need?
I would say it's somewhere in the area of $125,000 a year.
Okay, so you need $10,000 a month.
Yeah.
And so right now, what are you doing to pay for that gap between the Social Security, the pension, and the need? Where are you drawing from?
Right from the taxable account.
Okay.
Yeah.
So, we cannot drain too much of your liquidity. We just can't. If you had $3 million in your taxable account, then I might say it's not really there's a rule of thumb, but the rule of thumb is that we cannot leave you with too little money in this account. So at the very least, what I would say is at age 70, okay, what will the Social Security benefit be that he'll claim?
Oh, it'll be about $4,000 a month.
So at that time, then you'll have much more of money, coming in. You'll have 8 out of your 10 or 11,000 that you'll need, right? So that's good news. So what we need to make sure is, no matter what, right now, there's 2 years of your need that is set aside. So for right now, the next 2 years, essentially, I want to make sure that you have enough money. Okay. And that means money in case you need a car or something bad happens, and also the income that you have to fund. So then if you said to me, okay, well, we got that set. I'm going to pretend, let's just say that's 150 grand total ish. Okay. And now you have $200,000 that's left to pay taxes when you do your conversion. And so what I want you to do is to back into this. Instead of saying, I'm going to convert up to my tax bracket, it's really saying over the next 3 years before he has his Social Security kick in, how much can we convert and not drain our cash? That's the real issue, right? Because I cannot afford, and you can't afford, to have too little money accessible to you at this point in your life. So let's guess that of that, let's say that, how much have you been doing in the conversion so far? How much was the gross amount?
Last year, we converted a little over 100,000.
Okay. And so, you ended up, unfortunately for you, hello, New York State, you've got a nice fat tax. So presumably you paid about 35 grand of that in taxes. Is that right? Maybe a
I
little
would
more?
say it was a little less because we were able to itemize because we did a donor advised fund.
Oh,
So
great.
yeah, so we did that. We fund the donor advised fund every 2 or 3 years, and so
Mhm.
we timed it for that reason and everything.
Great.
So,
Okay.
so
So that was great. So perfect. So if we said that you could keep doing about, I don't know, let's say 100 to, I think 100 is probably not a bad number. Maybe it's 120 for the next few years. So you stay in the 22. I wouldn't, by the way, I wouldn't go crazy if you actually ended up in the 24% bracket for a little bit of the money. It wouldn't kill you. It's fine. It's not going to be a ton of money. It's, because of the way progressive rates work. I think about 100 or 120 grand. Maybe you do a little bit more in the years that you're funding the donor advised fund. Then you will, hopefully by the time he is collecting Social Security, that you'll have, 800 grand in the Roth. And then at 70, you have to reassess at 70, right? Because then you have all that income. We see where tax rates have landed. Maybe you'll be able to do a little bit more. Who knows? But then he's going to start his required minimum distribution at his age 72. And you'll be not so far behind. But I think that that's sort of the general game plan. Now, have you guys made any decisions around living? Are you going to stay where you are? Do you have homes? Like, what's your guess
well,
here?
well, we own our home and we don't have a mortgage on it, so we're not really sure what we're going to do. And I guess my other question was gifting to our children. We have 2 kids, and we do like to give them money. And I wanted your thoughts about if we give them money out of our retirement account and have the tax withheld out of the retirement account, so that we're not taking it out of our taxable account. What do you think of that strategy? And we're talking about $10,000 to $15,000 for each child.
What's their tax bracket?
They're higher. They're higher.
Oh, I like your kids. So
Yeah,
why are you gifting if they're making so much money?
because give it to them now while they can use it.
But they have money, right? Do they
Oh
really
yes,
need it right this second?
they wouldn't turn it down.
Well, who would? But I'm just
Yes.
saying, you're young. I wouldn't be gifting so quickly right now.
Okay.
I'll tell you why. You don't have a ton of liquidity. You have a lot of money in retirement assets. And, if you choose later on, maybe when your husband starts getting the required minimum distribution, you may want to actually skip that distribution because you may not need that money and send that to charity, not the donor advised fund, right? Straight to the charity. So you could do the qualified charitable deduction if that still exists. Who knows? But if your kids don't need the money right now, I hate for you. Why are you paying the taxes right now? Like, I just feel like it's like, eh. I mean, you could, but I guess what you're saying is you want to arbitrage the fact that you're in a lower tax bracket. So you could potentially, yeah, okay. I hear that I'm never going to convince you otherwise. So sure, why not? You can pull it from your retirement account. Don't go above 24% though, because in the years when you do that, you're going to pop over 24%. If you want to do that, go ahead and do that. Well, who am I to say? Okay, if you want to talk Roths, just like Maureen, give us a shout. JillOnMoney.com, click the contact button. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. And this is the program that attempts to answer your financial questions so you can put your best foot forward. You can make your next best decision. Mark, by the way, you notice that our boy from Mississippi State, they lost that game on Thanksgiving. Oh, I feel so bad. I was really rooting for them. they were the big underdogs. I didn't realize what big underdogs they were until we got on the air with him, and I looked up some of the stats. So I hope your team wins this weekend, Mark. It's really like it was like a Thanksgiving miracle that the Jets won. I think that both teams won. It's a long way from any sort of winning schedule this year. So we'll see. All right. If you would like to join us, just go to jillonmoney.com and click on the contact button. And there you're also going to find all sorts of content. You can read the stuff that I write and listen to old shows, watch TV segments, and do check out the resource section. Mark keeps that up to date. And you can also sign up for our free weekly newsletter. Right now, we are going to talk to Mike in Georgia, who is joining us from the Capital One Bank virtual studios. Capital One, this is banking reimagined. What's in your wallet? Hey, Mike, how you doing? What can we do for you?
Thank you so much for taking my call. I'm really excited to talk to y'all.
First of all, you know that I'm a sucker for a Southern accent, so thanks for saying y'all. Don't call me ma'am. Let's go.
Okay. So I just wanted to check in. I have some questions on retirement planning, and do you want me to just give you some numbers or?
Yeah, tell us a little bit about yourself, Mike. Okay. How old are you?
I'm 55, and I'm married. My wife is almost 55.
Okay, so you guys are 55. You got some kids?
We have one 24-year-old who's almost completely lost. She's working full time, but saving for a down payment, so she'll be moving.
Oh, that's good. You feel good about that, right? Did she go to college? Did you finance that?
We paid for college, and then she did grad school and had some student loans, but they're almost all paid off. So she's saving up money, and she's doing a good job.
That's fantastic. So do both of you guys work?
We both work.
How much do you guys earn together?
Together, about $160.
Okay. And is that a good amount of money? You do what you want? You feel good about that?
Yes. Yeah.
Great.
I mean, would always like more.
Oh, who doesn't? But, you're living your life. Things are good. The kid's out. We're practically done. Tell me a little bit about your retirement contributions. Of that 160, are you both maxing out your retirement accounts?
Pretty close. We both have 403Bs at work. They're right on the verge of being maxed out. So we also put money into a Roth.
A Roth IRA?
Yes.
So when you're maxing your 403B, I just want to make sure we're on the same track. Are you putting close to 19,500, or are you also allowing for the extra catch-up contribution because you're over the age of 50?
No, I think I'm putting in like 17,000. My wife's putting in like 15,000.
Okay. I mean, I only put that out there because when you're over the age of 50, the only good thing that happens to compensate for the fact that every part of your body will hurt at different points of the day is that you get to put an extra $6,500 in. So in other words, if you're over the age of 50, for everyone listening, the normal contribution is $19,500. And if you're over the age of 50, you can put an extra $6,500 in for a total of $26,000. Mike, how much are you guys putting into your Roth IRAs?
We're trying to do 7,000 a year on that. We just started that last year, and we're both at 10,000 right now.
How much money have you socked away in those 403Bs?
We both kind of relatively new jobs. My 403B has 28,000. My wife has 57,000.
Mm-hmm.
And then I have an IRA from previous employments, a traditional IRA with E-Trade, 550,000 in there.
Yowza.
And then I also have a small brokerage account, which is like $1,000 in it. And then my wife has an IRA from a previous job. It has 45,000 in it.
Mm-hmm.
And then she used to work for the state and is eligible for a pension. So that's why hers is not as high as mine.
But it sounds like you married well. If you married someone with this pension, right?
Yes. Yeah.
What is her expected pension benefit, and when does it kick in?
She's not eligible until she turns 60. At 60, it would be $2,100 a month. At 65, she has to take it at 65,
mm-hmm.
and that would be a little bit over $2,500 a month.
Wow.
And then
holy smokes.
A nice thing on that is because it's with the state, we can both be on the state healthcare plan. Yeah.
And for you guys, as you look ahead, do you feel like you are, on track to retire at some age that you've already picked, or are we trying to figure out when you can call it quits? What's your goal here?
Well, my wife would like to quit at around 62 or 63. So,
Mm-hmm.
7 or 8 more years, I guess. And
Okay.
I can go a little longer, 65 to 67.
And how much do you guys need to live on? Like if you think about, you are putting a bunch of money away, right? So
Right.
you guys are putting 32 for like almost 45 grand a year away. How much do you think you need to live on really out of that, the amount of money you're making, this 160?
I've been working on that and trying to get a real good feel for what we have to have. But I would
Mm,
say 5 to 6,000 a month, and then having our health care, paid for also. So
right.
assuming her, it would go through the state, then just maybe 6,000 a month
Okay. That's great.
that would be oodles for us to live on. So
Really?
yeah,
I like oodles. Tell me about the house. How much is it worth?
375.
Is there an outstanding mortgage?
No, it's paid off.
Any other debt that's floating around for any odd reason?
No debt at all.
Okay, if you want to come on the air with us, it's very easy. We're just here for you. So we'll get back to Mike in a second, but go to JillOnMoney.com, click the contact button, and there we will get all of your information. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money, and we are here trying to answer your financial questions. Let's get back on the line with Mike from Georgia and finish up his planning questions. What else do we need to know about you guys that I'm not asking you? And what is really the question that prompted your contacting us?
Okay, I have 2 questions. The first is, we just found out that both our employers have 403B Roth option.
Mm-hmm.
So because I have so much in pre-tax, we decided to start putting everything we can into Roth. Both of
Yes.
our employers, the match goes into the traditional IRA
Yep.
or the
Yep.
traditional 403B.
Yep.
But
I
I
would
just
do
want to
that.
make sure that I'm doing the right thing.
You're totally going to do that. And what's the investment company through work that you have accessible to you guys?
a combination of different mutual funds. I have the Vanguard S&P 500. All mine's going in there.
Mm-hmm.
And then my wife has, I think, a TIAA S&P
Oh,
500 available.
so she's TIAA in your Vanguard?
Actually, we're both TIAA.
Okay. TIAA is the gold standard. I think what I would do is I would make your entire contribution the Roth contribution into the Roth 403B, essentially have all of the money that you're putting away for retirement through the Roth 403B at TIAA. Could you potentially, I don't know if you can do this, could you potentially roll the traditional IRA, that 550 grand you have at E-Trade, now Morgan Stanley, could you roll that into your existing retirement account and put it all in like one place?
I don't know. I can ask. I'm not
I
sure
would
about
ask
that.
that. Do you like managing your E-Trade account?
I do enjoy it.
Oh, you know what? Then don't do it. I don't want to be a buzzkill. I mean, I can be, but I don't want to be. That's fine. If you like doing it, then you do it. How are you investing your E-Trade account?
Almost all index funds.
Okay. I would definitely use since you have all that money already, then I would use the Roth 403B for both of you, and I would put in 26 grand each. That's what I would do. That's exactly what I would do.
So withhold
Now,
more at work, and then instead of paying an
yes.
additional $7,000 a year.
Yes.
Okay.
Exactly. Do you have any money that's on the side? Do you have a safe emergency reserve fund?
I do. We have about 60 grand in the bank.
Great. And then you said you had a second question. What is that
Yes.
second question?
So I have another asset that I haven't mentioned yet. I have over the years collected precious metals, and I have about 125,000 in gold and silver. Some of it was inherited. Some of it I've bought years and years ago. Some I bought a little bit recently. It was never my plan to have this much money, piled up in gold and silver. The price of the metals have gone up a bunch in the last 5 years, and so now here I am. It's like a part of me. I hate to get rid of it, but also know maybe that's not the best thing to have that much piled up.
Do you own physical gold and silver, or are we talking? Oh, you do.
Yeah.
So, are you storing it someplace?
Most of it's in a safe deposit box.
And you have gold bars, gold coins, whatever.
Mostly coins.
Coins. Okay. I was a gold trader. My first job on Wall Street, by the way.
Nice.
So I'm looking at my commodities badge right now as I talk to you. Here's how I feel. I mean, the gold trade is sort of like the crypto trade. It's like the Armageddon trade. Okay. So if we just eyeballing your assets, I'm just going to do this quickly. 556. You probably have somewhere around $700,000 or $800,000 in invested assets, right?
Correct.
Okay. Normally, what I say to people is, if you want to have a illiquid asset, an Armageddon kind of trade, that I would be happy if you kept that to 5 to 10% of your total invested assets. So that would argue for, I don't know, like maybe you'd have, of the 125, I would say the most I would keep would be 75. Okay. And the rest you should peel off and you should sell it. Or you can give it to somebody. Maybe you want to give some to your kid or something and just, have that. But I don't know. I think that you have done a great job in managing that. And luckily, we're in a sort of inflationary period. And I think that asset could be worth more in the future. It's just that I don't want to have that big bet sitting on the old roulette wheel. Right. I would rather you kind of peel it back a little bit. I presume that there's, it's a sort of a pain in the neck to sell, but, I think you take advantage of the fact that the asset value has gone up and you pay your long-term capital gain on it and move on.
Okay.
And that's it. How would you sell it right now? Through some sort of dealer?
Yeah, or a coin shop. They would buy a lot of the stuff anytime.
And I'm pretty sure that they will issue something. Don't monkey around with this. So you are going to say, I bought it at blank, this price and time. Don't be a pig. And then you said, I'm selling it at this, and you're going to pay your capital gains rate, and you're going to move on. And that's it.
Okay, great.
Is that, you feel okay with that? Like, I'll let you keep it, but I just don't want you to have so much. Do you want to go crazy? Should we do something fun? How much is the loans that your kid has outstanding?
Oh, just a couple thousand. So
I'll pay that off.
Yeah, that's a good idea.
Okay, so now if you have a question, you know what to do. Go to JillOnMoney.com, click the contact button, and don't forget to just bookmark the Jill on Money site because it's going to change soon. It's going to be a lot of fun. Tell us what you think. Okay, we'll be right back. You're back. It's Jill on Money. And before we break for the first hour, we're going to answer an email question from Catherine, who taught me something, Mark, because she wrote these three initials, SIL. She said, SIL recently told me. And I said to Mark, what's SIL? And Mark had figured it out already. I did not, because I, of course, read it as silver. That's not how you say silver. That's not how you do silver. That's not the way they do it on the markets. Anyway, Sil, Mark says, is sister-in-law. I never knew that. Thank you. Thank you, Catherine. Okay, so here's what Catherine writes. Sister-in-law recently told me that after 10 years of retirement and not touching retirement money, the government takes 40%. She said they've implemented this new law to cover monies paid out to young families during COVID. Is this true? I haven't planned on using my retirement money. I was going to let it grow until death and my children could have it. Please advise. Catherine and Catherine's sister-in-law, take a deep breath right now. The government has not taxed your retirement money, okay? And so and this is the bet that you made with the government a long time ago. When you take a retirement contribution and you push it over, like you take a pre-tax contribution, you push it over into a retirement fund, an IRA, a 401k, a 403b, you push that money over. It hasn't been taxed yet, right? You haven't not earned that income. And so it goes into a retirement account. And then when you take it out later, it gets taxed. This is not some fanciful new law. Your sister-in-law, I will just say to you very nicely, is a dope, because this is just the law that exists. The money must come out. You are required to take money out of a retirement account if you have not done so, starting at age 72. And if your sister's not aware of it, that is the rule. And there it is. Mark, was that too mean? It was a little mean. Mark is being driven nuts on this also. Okay, so the reality is, gang, you have to pay your taxes, okay? Stop complaining about it. It's annoying to us. Mark's annoyed by you guys. I'm not. I really love you all. You are listening to Jill on Money. When we return, it's some year-end planning with special guest, Brent Weiss. Okay, during the break, hop on to JillOnMoney.com, click on the contact button, tell us all about your dumb sister-in-law, and we'll answer the question right away. Okay, we'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back. It's hour number 2 of Jill on Money, and we are so happy that you are with us. If you missed any part of this program, don't worry. You know, you might be listening on your favorite station, your favorite local terrestrial radio station, but maybe you're just tuning in. It's the second hour, or maybe your market only airs 1 hour. Mark, there are still a few stations that do that. It's true. That said, if you want to catch up, we always have a little bit of a delay right after the show actually airs. You can go back and listen to it. Just go to our website, JillOnMoney.com, and click on the listen button. And you know what else you'll be able to listen to? Our 2 podcasts. We have one podcast called Jill on Money and another called I on Money. So you should check those out as well. Okay, so we're coming into the end of the year. It is December. So we want to bring in a guest who will help you figure out how to start your year-end planning process. For that, we turn to one of our favorite guests, I think maybe our favorite guest here on the radio show, Brent Weiss. He is a certified financial planner, the chief evangelist at Facet Wealth. Remember, Facet Wealth is our sponsor, and you can find out more information about Brent at facetwealth.com and check out his picture, because he really is. When I say evangelist, I think you'll see what I mean when you look at his picture. Okay, let's go to Brent. What is that first step people should be thinking about when they're thinking, all right, financial planning, year end, what should I do first?
The first thing that I do before we say, what should we do before December 31st, the end of the year, these critical deadlines we have to meet, is I always recommend taking a step back. And the first step is we want to take a look at our goals that we set for 2021. What did we want to achieve? Let's assess where we are and what do we have to do in the next, 2 weeks, 4 weeks, whatever we have left. Number 2 is we look back at life, personally and professionally, and what has changed. Did you get married, have a kid, start a family, buy a home, change jobs, whatever it is? Because changes that occur in this 12-month period that we call a year can dramatically or materially change the decisions we should be making before the end of the year. And the third step in that process is we look forward to the year ahead, so 2022, and start asking, what do we plan on happening? There's the unexpected, which we'll talk about later. But what's the expected? What are the expected changes we see coming down the pike? Are we going to get married, start a family, buy a house, change jobs? All of these things will change your cash flow, your budget, your income, your taxes. And so before we make these critical decisions by 12/31, we have to look at the bigger picture and understand what decisions are really going to empower us in our financial lives to make smarter, more informed decisions.
What about the people who are like, oh, this is great. Thanks, Brent. I never had goals at all for this year. I mean, there are those people, Brent, who are not crazy like us.
Here's the reason we don't set goals. And by the way, I have a whole theory on New Year's resolutions, why they fail. I think 90% of New Year's resolutions fail by February 14th. I think that's the date. Within 4 to 6 weeks, we all fail on New Year's resolutions because we're just not very good at setting goals. The reason we don't set goals is there's a couple of reasons. Number one is we don't know what to do. We just aren't sure where to start. Life is busy. I had an analogy the other day. Are you familiar with Highway 46 in North Dakota?
Why would I be familiar with Highway 46 in North Dakota?
Here's why everybody should be familiar with that road. It is the longest straight road in America, arguably. I've seen different debates, right?
Highway 46. I'm writing this down. And where is it, South or North Dakota?
North Dakota. Yeah. So here's the point. We often think life is this long straight road. Like, oh, everything we expect is going to happen. But really what life is like is a switchback on a mountain, right? We're going back and forth and back and forth. Here's one of the reasons we don't set goals is because we're not sure, right? Life seems to change faster than we expect it to. And we go, well, why should I set goals? Because next week, whether there's some major life event, getting married, starting a family, saving for education, retirement, we're just not sure what to do. And sometimes I say, pump the brakes for a little bit, maybe pull off the side of the road and say, okay, let me sit down and think about what really matters to me. What do I want to achieve this year?
If you don't know what to do, I like the idea of asking a question, what matters to me? When you talk about that too can change, right? Because what mattered to me in 2020 or 2021 might have been different than like the many years before. Maybe you actually found out what really matters to you in the last 2 years. So I think it's actually an ideal time to set those goals.
Well, and it's going to change. And this is another reason we don't set goals is because either they're too big or we're not sure where we're really going. The most important thing I stress to my clients is the number, depending on your age, right? Your time horizon may vary. We have clients that are up from 95 now, I think, all the way down to like 22 here at Facet Wealth, and most of them are somewhere in between. But depending on your time horizon, the goal isn't to figure out what perfection is, because perfection doesn't exist. The retirement that I think I'm going to have in 20 years is probably not the retirement I'm actually going to have. The important part is knowing, okay, I should be saving and investing for something in the future. That's going to create financial security and financial independence at some point. It's not the number. And this is why we talked about this in the last conversation we had. It's not trying to find perfection in some number. $1 million, $4 million. Your life is so unique. The most important thing you can do is start today. And that's why over the last year, and will follow us in 2022, I'm a firm believer in this thing called the 1% pledge. It is the small changes you make in life. I always say that the 1% changes you make to your financial habits are like the compound interest to improving your financial well-being over time. It's not some magical $20,000, $30,000, $40,000 change you make in a given year. Yes, those happen, but they're rare. It's the small 1% changes that you make, the smart, informed decisions you make in your financial life that lead to longer-term success, and that's where you start to make the real difference.
What is it about this process that kind of throws people into a little bit of a tailspin? Is it because the unpredictability? Is it because it sort of forces you to sort of button down and create a plan? Like, what is it that you find in your clients or in the people you talk to that stops them even from the small steps?
One of the things I find is there's just so much going on, they're not sure what to do. There's always something that gets in the way. And I'll tell you, I work with a lot of clients that are either getting married, starting families, starting businesses. There's always something else sort of pulling at your purse strings, right? And then you got to go, well, geez, someone's telling me I should be saving 20% for retirement. I'm not even sure what it is. And it's like, well, the goal might be 20, but maybe today the goal is to get to 5. The other things are we're not ready to make changes because a lot of times the goals we set are too big. So the two biggest goals for New Year's resolutions are always, I'm going to get in better shape and I'm going to get in better financial shape. And if you think about the goals we make when it comes to our physical fitness, it's often, I'm going to lose 40 pounds. I'm exaggerating a bit here. Maybe that is your goal. And if it is, awesome. Let's hear about it. And let's do it. but they're often too big because you think, how am I going to lose 40 pounds? Well, it might just be changing one meal a day or just going for a walk once a day or going to the gym 2 times a week, not 7. Right. And so we don't know how to make goals that actually fit into our lives. And the last thing I'll say is we go online and we Google it. And it's like going to WebMD and it's like, oh, well, my ankle hurts. Well, you might have cancer. So you should be careful. Right. So if you Google what should my goals be, what should I do? You're going to find a lot of cookie cutter advice. And I think the audience knows this, full disclosure. I'm a CFP professional. I believe in the power of this. I think getting professional advice is the most important investment you'll ever make. It's not a cost, but I'm not here to sell anybody today. Getting personalized advice, unbiased, personalized financial advice to help you even just make decisions, get organized, figure out your goals can really be life-changing when it comes to figuring out what's the small step I should be taking? Where should I be going based upon my life, not based upon the 750 results when you Google it online.
We'll get back to our interview with Brent Weiss in just a second. During the break, why don't you just go check out Brent's company, Facet Wealth, facetwealth.com. Very easy to do. You just got to click over there. So give it a shot. Go talk to them. Go think about it and let us know how it goes. All right. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money, and we are here trying to help you navigate your financial life, take the next step on your financial journey, if you will. And to do that, we have a guest today, Brent Weiss. He is a certified financial planner. He's at a company called Facet Wealth. And Facet Wealth is our sponsor, and they are a financial planning company. Facet Wealth provides flat fee, conflict-free planning, and you get that planning from a dedicated certified financial planner. Why is that important? Because when you're looking at all the pricing, you're going to say, oh my God, their pricing is so cheap. It must be a robo-advisor, and you just get a random advisor. No, you get a dedicated certified financial planner, somebody who is a fiduciary, who's going to act in your best interest. No wealth or account minimums at Facet, so you may want to check that out, okay? Facetwealth.com, that is their website. So there's our business. Now we're going to talk to Brent Weiss from Facet. Again, he's I think he's a co-founder. Is he considered a co-founder or co-owner, Mark? He might be a co-founder. I'm not sure. Anyway, he's a co-owner. That'll be safer to say. And they're growing like crazy. So I like this because Brent, even though he is a certified financial planner, he is someone who is aghast when we ask for a rule of thumb. So here is more of our interview with Brent Weiss.
There are two things that I never follow as a financial planner, and that's rules of thumb and laws of averages, because I don't think of myself as average. And I'm sure a lot of people out there, the listeners, don't think of themselves as average. And your life isn't average. I'll give you an example. An article in the Wall Street Journal, if we use rules of thumb, was talking about the 4% withdrawal rule. What that means.
Yeah, we talked a lot about this. That's so funny.
Like you can take 4% out of your retirement nest egg, and that's how much income you can have. And I went to the reporter and I actually said, well, let me ask you a question. If you have $1 million in a traditional IRA and you take out 4%, that's $40,000. How much are you taking home? Maybe only 25 or 30. But if you have $1 million in a Roth IRA, and I'm using a round number, I like simple math, and you take out 4%, so you take out $40,000 from a Roth IRA, how much you take home? You take home 40 grand, right? So all of a sudden, this rule of thumb, you're like, well, that's a 10 to 15, 25% difference in income in a given year. Let's forget about rules of thumb. They're great places to start. Don't get me wrong. If someone says, save 15% for retirement, good place to start. But it may not be where you are today, and it may not be the number that's right for you when it comes to retirement, education for your kids, buying your dream home, whatever it is in the future.
So let's get into some granular stuff just for fun, because we did review our goals that you set for 2021. And if you didn't have them, maybe we think about 2022 and we ask ourselves what matters to me. So that's like your North Star. We look at our life changes. We look back, did you have a kid? Did you get divorced? Did you inherit some money, whatever, change jobs? And then we look ahead to 2022. Now let's presume not too many big changes from one year to the next. What are some actual, because we are running this in the month of December, are there some year-end deadlines that people should be mindful of once they've gone through that first round of sort of the bigger picture questioning?
Absolutely. So I'll break it into, again, I have frameworks and buckets here. So I think about it in terms of taxes, your investments, and then your plan. So let's start with taxes, because that's what a lot of people think about at the end of the year. How do I lower my taxes? I put taxes into 3 buckets, because one of the biggest mistakes I see people when they first come to me, when they think about taxes, is how do I lower my taxes today? And I go, you're missing actually 2 critically important things. So yes, we want to lower our taxes today, but we also want to put our money into accounts or investment vehicles where they grow with the least amount of taxes pulled out of them, right? So they grow with the lowest amount of taxes possible. And then when we pull the money out, we can pull them out in a tax efficient way, so lower our income in the future. So when we think about taxes, a couple of things you want to do. Number one, I do this for my clients all the time. It's not a fun exercise, but it's important, is we look at tax withholdings. How are we doing getting up to 1231? So you don't have a big surprise come April 15th. Number 2, we look at our retirement plans and we say, what are we doing when it comes to that 401k, the 403b, the TSP, depending on, so the elemental Ps where you are, right? Can you max that plan? Can you then think about, okay, IRA, Roth IRA contributions? What about a health savings account? One of the most amazing triple tax-free accounts that exists. And then I start thinking about, okay, let's think about the other goals. If you're saving for college or an education for your son or daughter, can we get money into what's called a 529 plan? That's because the Internal Revenue Code, it's section 529. It's called a 529 education savings account. All of these things matter. They have critical deadlines by December 31st. By the way, IRAs, Roth IRAs, lesser known thing, HSAs don't have to be funded until April 15th, so your tax filing deadline. But you have to think about it as part of your plan so you can start making smart tax decisions. The final piece here is whether or not you take the standard deduction or the itemized deduction. So if you itemize, which means you have to have some pretty good deductions, mortgage interest, state taxes, which that might get repealed, that might go up a little bit from the $10,000 cap. If you itemize, you want to start thinking about when you make charitable contributions, okay? Based upon income, this could be this year, this could be next year. Because if you take the standard deduction and you make a charitable contribution, you're not getting any bang for your buck from a tax perspective. Now, I will say this. There is, because of COVID-19, there's a $300 or $600 deduction you can take even if you don't itemize, but it has to be a cash contribution. So if you're if you're not married and you've made a cash contribution, you can deduct up to $300. If you're a married couple, you can deduct up to $600. If you itemize, now we can start thinking about, well, do you want to give some money to some local charitable organization? If the answer is yes, here's a trick. I see this mistake all the time. We write a check to charity. And you're probably thinking, well, why is that wrong? If you have a taxable investment account with some investments that have appreciated, grown in value, which we've seen the market go up quite a bit here lately, the best thing you can do is actually gift some shares of what you own to the charity, because you get 2 benefits. Number 1, you get the full tax deduction on it. But number 2, you avoid the capital gains taxes on the gift to the charity. So you get more money to charity, you save money on taxes, you avoid capital gains taxes, and the charity gets the full amount because they're a non-taxable organization.
If you are, like, we're talking to you, we don't have Build Back Better actual details.
Right.
And so I'm wondering, are you a fan of trying to do a Roth conversion this year while you know that you still can do it and there's freely and blah, blah, blah? Like, what's your opinion on the Roth conversion question?
I'm a big fan of the Roth IRA conversion, really the backdoor Roth IRA, the non-deductible contribution in the IRA, and then the conversion to the Roth. I love it. So if it's part of your plan already, absolutely do it this year. Because what you don't want is the government to take it away from you next year, if you're in that income tax bracket. If it's not part of your plan already, you have to look into it, because if you have a big IRA already, it's probably not a smart strategy. I don't want to get jargony. There is a pro rata rule that gets in the way that messes all of this up. If it's part of your plan, do it. It's one of the most important things you can do, especially if you can't make a direct contribution to a Roth IRA. Absolute home run from a planning perspective.
Last year, we didn't have to worry about required minimum distributions. This year we do, right?
Right. Yes, they're back.
I think that I have a feeling. Do you feel like that there's people going to blow through this, or will people pay attention?
When it comes to tax filing season, I always tell my clients, pull out last year's tax return as your baseline. Like, did we
Right.
miss anything? What are we reporting? And if you look at like, oh, nothing came out of my IRA, and also you go, oh no, I missed that deadline. What do we have to do? That required minimum distributions are back, and there's a twist because they changed the rules recently back in like 2020 that now you have to be 72 before you start taking money out. However, if you inherited a new account, you no longer get to stretch it over the rest of your life. It has to be pulled out within 10 years. So the IRS isn't making this easy on any of us. So if you have an inherited IRA or you're over 70 and a half or 72, you need to start thinking about, do I have to take that distribution? It has to be done by December 31st in most cases. But make sure if it's something you are even considering, you should be talking to a professional to make sure you get it right. Because if not, the IRS can come back and hit you with a 50% penalty on the amount you should have taken out. That is not a light penalty.
We'll get back to our interview with Brent Weiss in just a second. During the break, hop onto our website, jillonmoney.com, click the contact button, and send us your question. We'll be happy to answer it. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, and we are going to get right back into our interview with Brent Weiss. He is from Facet Wealth. He's a certified financial planner, and we are talking year-end planning. Now, remember, everyone, we did this last year. We talked about the home office deduction. Remember that the Tax Cut and Jobs Act eliminated the employee business expense deduction. That is through 2025. So if you're an employee, essentially, you can't deduct jack, okay? Just don't try it. You can't do it. If you're self-employed, that's fine. And a lot of people are self-employed. A lot of people starting businesses. So I do think that's one area that people always ask about. And Brent, if you wouldn't remind folks that the remote work tax implications, which are out there, like if you are from Maryland and you lived there, but then you spent 6 months of the pandemic in Florida, like what are the implications there and how should you manage that in terms of taxes?
If your taxes are complicated enough, you want to have a CPA. They're not going to charge you a ton of money. A good one won't charge. They're not going to charge you like $5,000. You want to make sure you get it right because there are reciprocity rules between states. So, I'm not saying this is factual, but if you live in Maryland, because that's where I used to live, and you were working remotely in New Jersey or Delaware to be by the beach, there are reciprocity rules that, in theory, where you earn the income is ultimately where you're going to have to pay the taxes. So you have to understand if you moved or had a second home or whatever it is, that you could actually owe taxes in different states unless there's the reciprocity rule where some states are going to say, don't worry about it. It might be hard, by the way. Don't take this as advice. It might be hard for the IRS to track you down unless you actually change your address or you have two homes or there's a change to how your employer paid you during the year. If they change sort of your state of domicile for the tax withholding perspective, then you're going to have some complication there. For the most part, if you were gone for a month, don't worry about it. If you made a bigger change or moved mid-year, you're going to have a pretty complicated tax situation. You want to make sure you get it right so you're not double paying in taxes or missing it. You get the nastygram from your local tax authority in a couple of years saying, hey, you didn't pay your tax. And you go, what, really? And you owe $5,000 or $10,000. I've seen that a lot, actually, in the past.
So now, what is it when we look ahead for 2022? What are some of the things that you want people to consider about how to, instead of making a resolution, let's talk a little bit about that 1% pledge of yours and also just what people should be trying to do as they look ahead. But what are some of the steps that people can start to think about to kind of get better with their money? Forget about like saying, I want to be rich. Like, how can I be more in control? What are some of your suggestions?
Well, it's interesting you made that comment. Like, I want to be rich as a goal. I actually had a client that gave me a number and just said, I want $5 million. And I just said, what are you going to do with it? He goes, I have no idea. I said, well, why is $5 million the goal? I'm not saying it's a bad goal, number one, to start, but like, what's the purpose of it? I do think looking ahead at 2022 and saying what changed in 2021, what's going to change in 2022, and start thinking about what do I need to do with my money? How to make smarter decisions with my money? If you're going to start a family, start thinking about college and all that kind of, buy a new home. If you move, if you're going to change jobs and maybe move, maybe you're thinking about finally, because you're working remotely, getting out of the city and going somewhere else. The first thing I think you need to do is just sit down again, getting financially organized. I cannot stress the importance in all of this.
What does that mean to you when you say getting financially organized? What does that mean?
Yeah, so I actually just wrote an article on this on our Facet Wealth website. Really 3 sections to getting organized in this article. But the most important thing is just start with the simple things. Your income, what you earn from your employers, like how much are you making, and then look at your deductions, what comes out of your paycheck, and that's everything from health insurance and your FSA, your HS flexible spending accounts, like all these different things. You should organize your taxes, and that just means get the last couple of years. How are things going on? What are your withholdings? All of that. Then you want to get to your budget. And I know people hate the word budget. I've tried using spending plan with people, but people know what a budget is. This doesn't mean you have to get it down to the penny. Just have a general sense of what it is. Right? Look at your insurance coverage. What do you have? Health insurance, disability insurance, life insurance. Doesn't mean you have to know everything. It's literally just writing that, yes, I have this. Yes, I have this, to make sure you're in a good spot. Estate planning documents, your investment accounts, 401ks, IRAs, Roth IRAs.
So when you're saying like get financially organized, it's like you need to know this information, maybe even just jot it down on a piece of paper, or even say to yourself, like, where are those estate documents? Like there, if you have them, do you know where they are? And like locate that. And for your investment or your retirement accounts, like look at the last statement, write down the number. Like it's not that difficult. It's kind of like you just want to have like a simple accounting, right?
Yeah,
that's really it.
It's sort of look, here's the thing. I'll make sort of a joke around this. This doesn't have to be a Van Gogh painting. It can be a crayon drawing kind of thing. Mm-hmm. Because all you're trying to do is what are the different pieces of the puzzle that make up my bigger life picture? Mm-hmm. You don't have to know everything. I actually have this conversation with a lot of new clients that come here to Facet. And it's primarily like, hey, what do you make in a given year? Or what do you have in your investments? Like, I don't even need an exact number. Just give me a ballpark. Mm-hmm. All we're trying to do is get a sense of, okay, what is out there? Like what exists? And then and here's the key to 2022 when you think about setting goals and all of this. If you don't know what the bigger picture looks like, just start with this simple thing, map it out, different categories. Mm-hmm. Check out this article, by the way, to give you a nice little easy way to work through this step by step. The next piece is then pick one section of that or one area and say, you know what, this month I'm going to organize this. So maybe this month you look at your investment accounts, and then so January might be your investment account month, and then February might be a good month for taxes because W-2s and your tax forms come out. And then March is maybe insurance and estate planning. By the way, you can pick more fun things, but that might be a really easy way, sort of a 1% change every month versus saying in January, I'm going to get everything. And then life happens in the first week and you can't do 15 things and you don't do them. Now, as you organize each of these areas, let's use budgeting because that's a simple one. And you organize your budget, say, here's where my money's going. The next step in all of that is then say, what's one thing I can change to put money towards something that matters most to me? Here's a question I ask a lot of people. Tell me the 1, 2, or 3 things that matter most to you right now. And maybe like, I've always, we're about to buy our dream home or we're about to start a family. And I go, cool, write it down. And then I say, okay, now let's actually look at your budget. And then we look at the budget and I go, is where your money's going today in line with those things? Most of the time, the answer is no, or it's like 50-50 when it comes to that. So every time you organize an area, try to pick 1, 2, 3 goals max or changes that you want to make in the year ahead. And that's a very easy and simple way to start setting goals in each of these individual facets of your life to get ahead in 2022.
Okay, we'll get back to the most interesting part of our interview with Brent Weiss in just a second. If you've got a financial question, hop onto our website, jillonmoney.com, and click the contact button. We'll be right back.
.401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
you're back. It's Jill on Money, and we are here to give you great information, help you plan for your year end, and try to make this accessible for you. If you have a financial question, all you need to do is hop onto our website, jillonmoney.com, and you click on the contact button. Just so easy. Tell us your question, and if you are willing to come on the air with us, if you're willing to come with us in the Capital One Bank virtual studios, then we'd love to have you. It's just so easy to do. So jillonmoney.com, click the contact button, ask your question, and say, I want to come on the air. Mark does everything else. Okay, now we are going to finish up our interview with Brent Weiss from Facet Wealth, and we are going to get an update on what we call Brent's 1% challenge. Just doing something 1% better. That's all it takes, just 1%. And we try to apply this with you guys. We don't actually say the 1% challenge, but I like it. And I always like to tease Brent about where he stands with his challenges. So here is the conclusion of our interview with Brent Weiss. Are we ready to do your 1% pledge or not?
You're going to be blown away. I mean,
All
this
right,
might have to be a whole separate session.
I was just going to say that so for those of you who have listened to the show for a while, you know, Brent, who is from Facet Wealth, the sponsor of this show, comes on. And by the way, he is a certified financial planner. He is one of the co-owners of this company. He is the company's chief evangelist. One of the things that Brent was very clear about is that he wanted us to hold him to a 1% pledge every single time he came on the program. Mm-hmm. So this has been like what his 1% was like estate planning. He kind of blew it off for a while and this, that, and the other thing, but there's all sorts of things. So Brent, tell us about the 1% pledge for December 2021.
2 comments to kick this off. Number 1, I want to thank you for being my accountability partner, because if it wasn't for you last month kicking me in the backside, I probably would not have done anything. So number 1, thank you. Accountability partners matter. Number 2, I'm a financial planner and I still failed at my 1% pledge when it comes to my money goals. And so if you're out there in the audience, you're not alone. I'm right there with you. I tried to make up for all of that in December, here November, December, around the holidays, because I have a lot of big decisions to make. So here's what I actually did. So coming out of that last session, I scheduled calls with my CPA, mm-hmm. with my estate planning attorney, and mm-hmm. with my banking relationship. And I'll share with you why. So I sat down with, and actually, I guess I can't mention the university anymore. My alma mater, we'll leave it at that.
Whatever, Notre Dame.
Right.
Continue.
I scheduled some time with them too, because I'm thinking about giving to that university in a meaningful way. And that matters to me. Or when you think about defining what really matters, I'm a firm believer in the power of education. I got a scholarship to go to Notre Dame. Otherwise, I couldn't afford it. Mm-hmm. I want to make sure I pay that forward and make it possible. So we're talking about some gifting strategies to make it work.
Okay.
So I sat down with my estate planning attorney, and there's a couple steps here because I have to establish some trusts. Okay. One of them mm-hmm. will be a revocable trust, meaning it exists now. Like it's a living inter vivos, meaning during my lifetime trust. And we're thinking about a life insurance trust as well. Mm-hmm. So we're working on that process in terms of what I should have, the amount of life insurance I should put in the trust. So I actually also scheduled a meeting with my insurance agent. And while mm-hmm. I am a CFP professional, I don't sell insurance, but I have relationships in that area to talk about what kind of insurance could make sense, to start understanding the cost of it. And then I sat down with my CPA and said, what decisions should I be making in terms of my gifting strategies for charitable contributions? Because full disclosure, I may actually take the standard deduction this year. Mm-hmm. I have a small condo in Baltimore with like $4,000 of mortgage interest. If I give to charity, I'm not going to get the tax bang for my buck. So I'm thinking, do I make contribution this year, or do I wait until next year where I may have more deductions? Because the reason I spoke to my banker is I want to figure out what kind of loan I will qualify for, because I'm looking to buy a home. So this is like my 8% pledge catch up in December. I have not executed the documents because there's a lot to this. Wills, financial power of attorney, healthcare power of attorney, at least one trust, my revocable trust, which is smart for the rest of my assets, and then potentially a life insurance trust for longer term, making sure my family's okay, estate taxes, all of that kind of stuff in the future.
That's a lot, man. But you played catch up. I like it. I think that's great.
Well, I procrastinated until this 12/31 deadline came around.
But you know what? I think what you're saying to everybody is none of us is perfect. None of us is getting this all right. Like anything else, you do the best you can. And if you run into an issue or you need some help, it is good to have an accountability partner.
Mhm.
It is good to have a friend, a nudge, an Aunt Jill, a brother Brent. And I think that makes a lot of sense. And of course, the only thing that I am most not concerned with, but my goal for you is it's the 100% pledge for 2022. Just going to put it out there. Aunt Jill would be very happy to attend your wedding. Okay.
If you could only see my face when you were saying there's something coming down I knew what it was. I was like, it's coming. It's coming.
Yep. So that's it. Well, yeah, I think it's going to happen. Anyway,
we will see.
We are very delighted to have you as our guest and our sponsor, and we want to wish you continued great success. And we are so happy you shared your time with us and your expertise. Okay, so now you know Brent is on the road to making up ground lost after blowing off his 1% challenge. If you need some help getting back on track, if you want to try to help yourself, your family get back on track, just go to the website, jillonmoney.com, click the contact button. We'll be right back. You're back. It's Jill on Money. And before we finish up the program today, we just want to thank you all for listening, of course. And we want to remind you that all week long, no matter when or where that financial question pops into your head, just go to jillonmoney.com, click the contact button, and you can ask us your question. Rebecca did just that. Jill, I love, all caps, your program. I listen every day. She listens to our podcast, our Jill on Money Daily podcast. I haven't heard you talk about U.S. Treasury bonds. What are your thoughts about Series I U.S. Treasury bonds, which currently offer a 7.12% initial rate through April 2022? Would this be a good place to squirrel away some money that I may or may not use before the 30-year maturity? I'd love yours and Mark's input. Thank you so much. Mark, do you want to buy some I savings bonds? I like these bonds because, basically, so an I bond essentially has two pieces to it. It's a fixed rate and then there's an inflation rate. Here's the issue. They're great. It's fine. You're right. You can go right on to treasurydirect.gov and do this. However, you can't buy a lot. That's the thing. It's a very strange kind of product because you think, oh, great, I'd just love to plow a ton of money into this. I think you can buy $10,000. Isn't that right, Mark? Isn't that the most you can put in? And so it's great. You can put the money in there. And why not? It's not a bad thing to do. You can just pop it right in there. All the information is right at the treasurydirect.gov website. And, the rates change twice a year, but you can redeem them after 12 months. If you redeem these bonds before 5 years, you lose the last 3 months of interest. So it should be at least a 5-year hold. Okay. So I think that's it. I think we're done here, Mark. So I want to thank everyone for listening. Remember that here at the Jill on Money Show, we love to hear from you. So please just go to the website, jillonmoney.com, click the contact button. Tell us what's on your mind. We'd love to get you on the air with us. It's a lot of fun. While you're on the website, subscribe to our podcast, Jill on Money or I on Money, right there on the website. Our music is composed by Joel Goodman. Mark Talercio is our executive producer. And please do something nice for someone else today. It will make that person feel better, and I know it will make you feel better. Thank you for listening, and we'll talk to you next week.